Okay, so good evening, everyone. Thank you for joining our webinar today. Hopefully, every one of you are doing well. So my name is Shireen from Phillip Futures Marketing, and I will be the MC for today. So during the webinars, if you have any questions, do type them into the question box, and I will address the question during the Q&A sessions at the end of the webinars. So as usual, I need to emphasize on our risk disclaimer where this presentation has not been reviewed by Security Commission Malaysia and is provided to you solely for general information and does not constitute any recommendations. We are not liable for any losses arising based on these information. Investments are subject to investment rate. Therefore, you shall seek for advice from quality advisor before making any investment decisions. So now I will make some introductions on Phillip Futures. So Phillip Futures is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. It is incorporated on 7th of October 1995. Our headquarters is in Kuala Lumpur and our branches is distributed across Malaysia such as Kota Damansara, Melaka, Penang, Johor, Kuching, and our new branch which is opening at Kota Kinabalu. Other than that, Phillip Futures is the trading participant of Bursa Malaysia Derivative Berhad, clearing participant of Bursa Malaysia Derivative Clearing Berhad, and also holder of Capital Market Serving License, which is known as CMSRL. Next, I would like to take this opportunity to extend our gratitude behalf of my company, Phillip Futures, to our clients. Without you, we are unable to achieve the awards. So in 2020, we achieved three awards from Bursa Malaysia. The best overall, best retail, and best institutional derivative trading participants. Next, our mother company, which is the Phillip Capitals, we have office and branches over 14 different countries. For sure, for futures, we cover not only product in Malaysia, we all cover from different exchange such as Singapore Exchange, CME, CBOT, NYMEX, and more. With our strengths of global coverage, clients are able to trade both local and foreign products under the same platforms. So next, what is the product that available in our Phillip Futures? Our Phillip Futures are main focus on product offering are futures and CFD. So next, why should you choose Phillip? First of all, we are provide advisory service such as inquiries. Next, we provide wide range of products for futures that enable clients to trade both local and foreign products. Other than that, we will send out the latest market news and commentaries to our client every day through email for your reference. Lastly, our headquarters has 24 hours brokering and execution support. This is important for clients who trade foreign futures, and also dealer can assist your inquiry anytime. So without further ado, I would like to introduce our speaker for today's webinars. So his name is Mr. Lim Hong Sing, which is hold a bachelor degree in economics from University Utara Malaysia. With his passion in futures trading, he offers regular personal coaching on product and platform for investors who are new to futures trading. He also holds CMSRL license by Security Commission. So without further ado, let us welcome our Mr. Lim Hong Sing to start his sections.
Hi, good evening. Can you guys hear me? Okay.
Yes.
Okay. You guys also saw what I share on my screen?
Yes, Mr. Lim Hong Sing, we saw your screen.
Okay. So yeah, good evening, everyone. Today I'm the speakers that I'm going to share about our today webinar's topics is invest futures for better futures. So let's restart for our webinars. First, I have to make the risk disclaimer also. This is just information sharing, and then it's not having any of the sales or buy signal. Okay. So let's start with our today's topics. I'm going to explain with you all about what's the outline for our webinar first, and what we're going to talk one by one and step by steps. The first one I'm going to explain is what is futures contract. Maybe most of us, even that having investment experience in the markets, we have heard before about stocks, but we didn't know what is futures. So we're going to explain what is futures contract, and then we are going to explain also how futures works in real life. And after that, we're going to share about the terminologies in futures markets that you should know or understand before you're entering, or even is as a tools to understand more about the futures market. After that, we're going to explain also the advantages of futures contract, and I'm going to share at the end about the difference between stock markets and futures markets. Let's start. For the first part, I'm going to explain what is futures contract. So futures contracts are actually the derivative financial contract that obligates the parties to transact an assets at a predetermined futures date and price. What does it mean? It's actually, you can understand it as a contract with a buyer, a seller, that we make as for the buyer to make purchase, and also the seller must sell the underlying assets at a specific price, specific date, and also a fixed amount. How it can be understand more clearly, I'm going to give you all about examples. Like for example, today I'm farmers who grow durian. In my durian, I have my own land to grow my own durian. And you all know, especially as Malaysians, durians need sometimes for it to grow until it can sell on the market. So as a producer, as a farmers for durian, I need to make sure like when my durians already grow up, there's have somebody buys my durians. So I'm going to seek for a seller who are going to sell the person. I'm going to sell the durians in advance with making the contract with the seller. And within the contract, both of the buyer and the seller, both parties is going to discuss for a predetermined on the specific price. For example, I'm going to sell my durians 1 kg, maybe like 10 ringgits for you at a specific date, like after 3 months. 3 months is the times that taken for my durian to ready to sell off. Okay, so it's a specific dates inside the contracts, and also we will have a fixed amount for each contract. Okay, I there have a brackets for per contract. That means like a contract I make with you to sell my durian, a fixed amount. For example, I'm going to sell you 100 kg for one contract. Okay, so what if you wish to purchase more, or even I have as a seller I have more to sell off? If I want to sell another 100 kg extras for the durians, I need to make for the second contract. Okay, this is what it means by per contract, which means each contract there is a specific fixed amount. If you are going to buy more than the amount, then you need to purchase for another futures contract. There are 2 in total if you are going to sell for 200 kg. Okay, so after understanding what is futures contract, we're going to explain that what is the futures product that actually having in the market. The example that I'm using just now is about the durian. So what is the real products that are actually trading in the markets, or even that we can see in the markets? There's actually 2 types of futures products that are having in the market. First type is the commodities types of futures, just like the durian that I've shared with you all just now. And then there's another type of futures that are called as equity futures. Commodity futures are involving like the agriculture's products, crude palm oil, wheat, corn, coffee, and also some things that I've just said is about the agriculture's types of products. And the second types of the products is the metals, as for example, gold, silver, coppers, that are quite famous in these trading markets. And then another types of commodity futures are the energies that are involving like natural gas, gasoline. So there's another types of futures that are equity futures involving indexes. For FKLI, Hang Seng Index, Dow Jones, China A50. Okay, this maybe is a more related product, or even like more understanding for is more related like with you in your life for those. And then the second one is interest rate, which maybe never heard so much about this. They are actually having the futures for interest rate also. They are involving, for example, US Treasury bonds, and then the Calibor. Calibor is actually the interest rates for Malaysia's banks, interest rate for Malaysia's. Okay, so there's different types of the futures products. So how are the futures actually work in our real life? In futures markets, they're actually having three types of player inside the markets. Okay? Have the first one is the hedgers, the second one is the speculators, and the third one is the arbitrage. I'm going to explain it one by one, and I'm going to explain what they are doing in the markets, what their characteristics, and how are they going to gain from markets. For the hedgers, these are actually persons who manage the risks and uncertainties of financial instruments or commodities contracts fluctuated. For examples, hedgers in the markets involving are the commodity producer. Just like the example that I shared before, in the first part is for the durian producer. Okay, what's the risk they are facing for as a durian producer? They are worried the durian price goes down. So they need to protect the commodities products from downside risk for the commodity producer. What they are going to do is they can go through for the futures contract to fix or even like to lock the price in a specific dates. For example, for the durian's price, 10 ringgits per kg is a quite good price for me for a commodity producer right now. So I'm going to lock the price in these times for a specific month. For example, 3 months later, I'm going to sell it for 10 ringgits per kg for the price of durian. But if I can avoid the risk if that after 3 months the price of durians eventually goes down. For example, maybe after 3 months the durians got many of productions, then it's a season of durian. After that the durian's price become like maybe 8 ringgits per kg. So as the commodity producer, I actually having losses of 2 ringgit per kg. So as a hedger, I can use the futures contract to lock the price to avoid the downside risk. And then the second types of the persons is as a hedgers is a wholesaler, retailer, or manufacturers. There's the same examples or even the same theory and situations for the commodity producer. It's just that it's changed to if like I'm an ice cream producer and I'm going to produce the ice cream of the durian favorite. So I need to buy durian for as an input. When the price of durians goes up, is eventually will become one of the losses for me because I have to pay more to buy on the durians. If the price of durians eventually goes up, like maybe 20 ringgits per kg where I need it, so it will become a risk of for the price of durian goes up. For hedge away for the price risk, I can also go through for the futures markets and I'm having a futures contract to lock the price for the durian so that I can avoid the risk that can impact my impacts to those of the wholesaler or retailer. So the third type is the portfolio holders in cash markets. Okay, so what does it mean? Like just previously, at the front section, I actually shared with you all for the futures contract, they are actually involving like the indexes. For example, for FKLI, okay, like if you are portfolio holders, then you, for example, you are having the AA shares stocks in your hand, okay. Then during the pandemics of the COVID-19, you know that you have experienced a losses, okay, for your portfolio its own, but you are not decided to let go of the portfolio. So at this moment, you can hedge the portfolio risk by shorts the markets on the FKLI. Okay, you can buy against the different directions with your portfolio so that you can hedge away the risk for your portfolio in the cash markets. Events like having some of the events that will impact for the whole economics. Okay, so this is another type of hedgers in the markets, which is the portfolio holder in the cash market. So second types of the players in the futures market, the speculators. Okay, speculators is who speculates or predicts on the direction of the futures price with the intentions of making money, or even we say it as they are willing to accept the risk so that they can make money from the risk. Okay, for the hedgers, they are trying to avoid the risk. They transfer the risk to the markets, to the futures, and the speculators are accepting those risks so that they hope they can gain some things from the risk. So speculators are important to the markets because they actually bring into the liquidities for the futures market. So for examples, here I'm showing pictures for typical speculators. Okay, the speculators on Monday, they actually estimates the price of gold goes up. So they're going to buy a pile of gold on Monday. So on Wednesday, when the price of gold eventually goes up, they can sell the gold at a higher price within just 1 or 2 days. So they are actually making profits from these transactions. Okay, there's actually risk inside here. What's the risk taken by the speculators? Is actually the gold may not rise as what is expected. Okay, so this is the risk they are actually taking by this speculator. But eventually, if the estimation is correct, then they will gain from the transactions. So this is what speculator doing. The third one, the arbitrages. Okay? Arbitrages are actually traders who buy and sell to make money on different price and a difference across different markets. For examples, yeah, there are actually ice creams at market one. They're actually only $1 per ice cream. Okay, but after that, he found out that the price for the same ice cream at another markets at market two is worth $5. So for arbitrages, they're actually doing this kind of buy and sell within two different markets for same things but with a different price in the different markets. So they are actually arbitrages who buy lower in markets and then sell higher in another market. This is what arbitrages do in the futures market. So after understanding there are three types of persons that are working in these futures markets, I want to explain contract specifications for those real futures contract that are trading in the current markets or even like the Malaysia's markets. Okay, I'm going to introduce two contracts for the Malaysia's locals contracts there, which is very famous. First one, the crude palm oil futures. This is underlying for these futures is crude palm oil, as I've been said before. So just for information, if some of you didn't know what crude palm oil is and what crude palm oil actually used in our real life, you can just understanding crude palm oil as edibles oils, cooking oils that every one of us is using every day. Okay, so this is what crude palm oil actually represent on. They are also able to mix for some of the soap or even like involving in some of the manufacturing progress for some of the foods. Okay, so after understanding what is crude palm oil, so this is the futures for trading crude palm oils that's underlying on the crude palm oil. The contract size for this particular futures contract is 25 metric tons per contract. Okay, as I mentioned before, they're actually a fixed amount. So one contract of the futures FCPO or crude palm oil futures contract is represent 25 metric tons of crude palm oil in the real life. Okay, you are trading to the reals of the crude palm oil. There are physical items in there. So for the pricing units using the FCPO is Malaysia ringgit because it's a Malaysia's products. Then the trading hours for FCPO, they have two sections. First section start from 10:30 a.m. to 12:30 p.m. and you will go through a rest sections and then continue in the second section of 2:30 p.m. to 6 p.m. Then for these FCPOs, they actually have different contracts months, which involve the spot month, which is the current month, and the next 11 successive month, which means like currently we are at November, but you are actually able to trade for the crude palm oil, even the crudes that are coming on the next year of January, next year of February, next year of March. Okay, there are different months for FCPOs to trade, which is having 11 successive months, and thereafter for FCPO. Then the minimum price fluctuations for FCPO is 1 ringgit per metric tons. They are also involving for the initial margins in these contract specs. Initial margins is a concept we call it as a deposit for you to hold on for one's futures contract. Okay, for example, you want to trade for this futures contract, then you need to have initial margins of 7,000 so that you can hold on one contract. Okay, this is the initial margins for FCPO. Okay, the settlements for FCPO is actually physical delivery, which means I've mentioned before, this is the underlying to crude palm oil. which means it's actually trading in the real life. Okay, for examples, like maybe the crude palm oils they are producing is actually maybe is the companies, for example, like the Samdabi plantations, yeah, they are actually growing for crude palm oil. So for this contract, they are actually settlements using the physical delivery. They are delivering the real items in this futures contract. Then the final trading dates for FCPO is 15 days of the delivery months. Okay, 15 of the days. If the 15 of the days is the public holidays, then it will becomes one day before the public holiday, which is the 14th of the month. Okay, so second contracts that I'm going to share with you all is for the FKLI, which is the equities futures. Okay, for FKLIs, they're actually underlying to the top 30 listed company of FTSE KLCI, okay, which is the indexes that are every day you are viewing on the news about the Malaysia indexes goes up or goes down. Okay, those indexes are underlying from the top 30 listed company at Malaysia's Bursa Malaysia on the Malaysia stock market. Okay, so for these FKLIs, they are also pricing unit using MYLs. For the trading hours, they are actually started from 8:45 a.m., which is 15 minutes earlier compared with the normal stock market. Okay, normal stock market start from 9 a.m., but for FKLI, we start on 8:45 a.m. and then we stop at 12:45, and then we go through for a rest. After that, we come back on 2:30 p.m. and we also close 15 minutes later, which is 5:15 p.m. Okay, for the FKLI contracts. This is futures, which is different with the stocks markets. Okay, this is a very important concept to share with you all. So the contract month for FKLI is the spot months, and then including the next month and the next two calendar quarterly months. Okay, which is the quarterly months are March, June, September, and December. Okay, so the minimum price fluctuations for this FKLI is actually 0.5 index point per minimum price fluctuations. Initial margin required for FKLI is actually just 4,200, which is different with the FCPO. Okay, FCPO is 7,000, but for FKLIs is only 4,200. And for FKLIs, the settlements using is the cash delivery. Okay, the final trading date is also different from the FCPO, which is the last business day of the contract month. Okay, so for just the informations for maybe others or even some of the audience didn't know what is top 30 company at the KLCI. They're actually very common companies or even a big capitals companies that actually come with every knowledge or even news that you are receiving. They are including bank sector, Hong Leong Bank, RHB, Maybank, Public, and CIMB. Okay, the bank sector you are very familiar with. And then also some of the top glove, Hatalega, IHH Healthcare for some of the health sectors, and then also involving some of the telecommunications, Maxis, Axiata, okay, and then they also have some of the plantations for Samdabi, Petronas Chemicals, and then some of the RI groups, Kuala Lumpur, Kepong Berhad. So their top 30 company at KLCI is actually a very normal company, or even like you know it before, like it's just within your life. Okay, it's not very different or even very far from your. So the next is go through for the terminologies in futures markets. Okay, so the three terminologies I'm going to share with you all. The first one is about the contract month. Okay, what is contract month means, and then the second one is for the open positions. And then the third one, I'm going to explain with you all what is the margin call in futures markets, okay, which is will not occur in the stock markets. So the first one, the contract month. Okay, especially when I share with you all for the contract spec, I've been mentioned about the having different months for the futures. They are having 12 consecutive of the months for trading. So for futures contract, we are actually having the delivery months denotes when a derivatives contract expires, okay, and when the underlying asset must be delivered or settled. For example, in these pictures you all can see, right? For the we have just show you all with the contracts months with a red circles here, and then for this, for example, I'm pointing this BND crude palm oil for October of 2021, which means this contract is going to expire on the last trading dates, which is 15 October. Okay, so the contract will be closed out. So for the futures contract that we're actually trading, they are come with different months that we have stated in our platform. Okay, they are involving like the December of 21, January 22, and also February of 22. So when you're trading for futures, you need to aware of which months that you are actually trading with, and the contract months or the contract that are holdings are expired on which month, on which date. Okay, so this is a very important terminologies that you need to know when you are comes to these futures. Okay. Second part, the open positions. Okay. Actually, for futures contract, how we're going to trade for futures? They are involving two types of open positions in futures contract. First one is the long positions, okay, which estimates the price of the underlying will rise. So we go through for long positions. Okay. For the example you see here, the graph that I'm showing here, you buy at a certain or the current price. So when the price goes up, the blue areas of the sides for the going long is going to having profits. So when the price goes up, you sell at a higher price, then you're having a profit for long positions. But there's different ways we call short position, which we estimate the price of the underlying will drops. Okay, so it comes to the second graph here. You can see the blue areas are actually go at the downsides, which is you're going to have the profit when the price is lower, it goes down, more lower than the current price. So what you're going to do in the short position, you're actually selling at current price, and then when the price goes down, you buy back, okay, for the contracts to close up your position, so you're going to get profits. So no worries, I'm going to bring you all go through for examples, okay. So first we're going to start with the long examples, okay. It's quite simple examples, okay. The example we're going to use is for the BND exchange, and the products or contract we use for the crude palm oil, FCPO for November. The tick value, current tick value, for example, is 4,500. Value per tick for FCPO is 25 ringgit. Okay? So when you estimate the FCPO which goes up, the price of crude palm oil goes up, you're going to having a long positions. So at the open positions, what you're going to do, you need to buy a contract at the current tick value, which is 4,900 ringgit, 4,900 points. Okay, so after that, when the price goes up as you estimated, okay, it goes up for 10 points, becomes 4,910. Okay, you have been estimated correctly. So go through to close the positions, going to sell it on 4,910. Okay, so this situation, you're actually earning the 10 points as you estimate the correct directions. So the calculations here I show is that you're earning 10 points, and each point equals to 25 ringgits. So at the end, you're getting the profit of 250 ringgits. Okay, this is the example for long, how you're going to get advantages from the markets using the long positions. Okay, so another situation will also happen eventually, and your estimation goes wrong. Your estimate goes up. That's when the price decrease, this 10 points becomes 4,890, and you need to sell it, or even like you close the positions at 4,890. At the end, you will have experienced a losses of 10 points. Okay, same situation, 1 point equals to 25 ringgits. At the end, you're going to lose for 2,500 ringgits in this situation. Okay, so once it comes to when you're going to having one of the short positions, how are you going to short for the markets? I'm going to show you an example. First part is same situation for FCPO November contract, and the current tick values is same, is 4,900 ringgit. At this time, you estimate the price of the FCPO will goes down. Okay, what are you going to do if you think the price of the FCPO will goes down? You need to sell the futures contract to open your positions. Okay, you sell at 4,900. In this situation, you actually sell in advance. Okay, which means you have you didn't have anything to sell, but in futures market we allow you to sell in advance. Okay, So after that, when the price decreased as you estimated, it decreased 10 points, and it becomes to 4,890. So you close the positions by you buying back, okay, at 4,890. Okay, at this moment, by showing the figures in this PowerPoint, you can figure out, or even like you can notice that you're buying at a lower price and you are selling at a higher price. Even though you are go through for the sale action first, after that you just buy back to cover up, or even we call it as close your positions. So at this situation, you are actually earning 10 points. How's the calculations going on? Yeah, you need to use this. You're selling at 4,900, but you're buying at 4,890. So you're earning 10 points from this transaction. Okay. So each point, as usual, is 25 ringgit. So you're gaining the profit of 250 in these transactions. Okay. It's also a quite simple uh, logics. Okay. So another examples I'm going to share is also same is the short examples, but eventually your estimation goes wrong. The price goes up 10 points while we are selling at 4,900, but the current price is 4,910. And you close the position at a higher price, 4,910, which at the end causing you to lose for 10 points, which the 10 points is also equivalent to 250 ringgit. Okay, so this is how we're going to save for the open positions, for the long or for the shorts. Okay, so the first parts I'm going to share with you all is the margin call. Okay, what will be the meaning of margin call in futures markets? Margin call is actually occur when the margin account run lows on the funds, usually because of losing trade. Okay, as previously I have said with you all, the initial margin you are required to trade for one of the contract, or even like the futures contracts for different type of contract. For FCPO is 7,000, for FKLI is 4,200 ringgit. So when you are losing your monies in the markets and the equities that you are having is lower than the maintenance margin or the initial margin required, as you are receiving the margin call from broker house. Okay? Very simple concept, as you need 7,000 to hold one contract, but the current money or even equity you're having is only 5,000 ringgit. So you are not enough deposit, or even we call initial margins, to hold for the contract. That's why you're going to receive for the margin call. Example I'm going to share with you all. Day one, okay, margin call usually will just experience when you are experience losses lah. So this is also a losses example, and explain to you all how the margin call is going to occur in what situation. Okay, on day one, when the FCPO you goes for a long contract at 5,000 ringgit, 5,000 contract, and after that, markets dropped 4,950, which you lost for 50 points. At this situation, 50 points is equivalent to 1,250 ringgit. Okay, you losses for 1,250 ringgit, but the initial margins that you are paid to trade is 7,000. So when you experience losses, the losses will going to take from the cash or even the initial margin that you are placed with. So after these losses, on the day two, equity or even the cash you are having actually left with 5,750 ringgit. Hence, you can find out that you are not enough of the initial margins to hold for a contract. Since the initial margins required is 7,000 ringgit per contract. So if you wish to hold the contract, or even you need to top up if you want to hold the contract, due to the equity is actually lower than the maintenance margins. So the difference between these equities and maintenance margin will be the margin call amounts that you are receiving, okay, from your broker. Okay, so it's 1,250 ringgit margin call. Yeah, so this is what margin call in the futures markets, which if you wish to answer the margin call, you need to bank in 1,250 ringgit to a trading account so that you can hold for the continues to hold for the positions. Okay. So at the upcoming part, I'm going to share the advantages that actually you're trading for futures contract. Okay. explaining so much about futures contract. So what is the advantages you wish to trade for futures contract? The first one is the leverage investment. I believe that you all can mention from the previous parts. Actually, for futures contract is leverage investment. Okay, and the second one is the high liquidity, and the third advantages is actually a bi-direction trading. Fourth is there's a low transaction cost for futures contract. Okay, next one, leverage investment. Okay, for futures contract, actually have giving a large contract value with a relatively small amount of capitals. This is actually part of the efficiencies for the capitals. Okay, how did this come from? Examples for the KLI's contracts. Okay, FKLI contracts, the initial margins required is only 4,200 ringgit. You just only need to pay up 4,200 ringgit to hold one FKLI contract. But the real value for FKLI contracts is actually equals to 75,000 ringgit, since 1 point of FKLI ringgit is equals to 50 ringgit. Okay, so we can realize that this is actually a leverage products that allow you to having, for in this example FKLI, to having 70.68 times bigger for your these deposits, to having or even explode to the high value of the contracts, which is 75,000. Okay, this is also a double sword which you need to caution of, because it will cost you to having a large of the earning or even gain, but at the same time it will also cost you for a more larger of your losses. Okay, for leverage. So this is one of the advantages that come with futures contract. They allow you to leverage your this initial margin. Okay. Second one is the liquidity. Okay, for futures contract, have actually quite liquid or even high volatility products even in the investment markets. So as the investor or as a trader, I believe you all understand that liquidity is very important when you are choosing which instrument or which items you're going to trade, because it's allow you to enter and quit the market in a quick pace. Okay, so in the futures markets, they're actually in a high volumes of trading per day. As you can see in the graph here, there's active months for the crude palm oil. The volume is reached for 30,000 per day, and even this is only around afternoon time. So in the futures markets, the trading contracts that actually come with a very high liquidities. Okay, so allow for you to invest or even to speculate in this market in and out in a very quick pace. Okay, so it's a very it's one of the advantages of futures contract. So the third one is the bi-direction of trading. Okay, futures contract will actually allow you to short the markets, which you are getting short exposed by selling a futures contract, and it is completely legal and applies to all kind of futures contract. Okay, in this situation, you're actually having more opportunity. Not only have to wait until the view of the market outtrend, you also can get advantages from the markets. Okay, how does it mean for more opportunity in the markets? Here come with one of the example I'm going to share with you all. Okay. The graph I've taken is from our official apps, which we call Philips Nova. This is the graph for FKLI contracts. Okay, you can see it here at this arrow goes up when the mix comes lower and the borders within Malaysia open up. Okay, the gaps goes up. So at the moment when you know the government is allowed for the markets or even the borders to open, you know they are having an uptrend for the FKLI. So there will be having an opportunity for you, especially a trader or even as speculators, to trade by having a long positions. At this point, you can buy in to enter the markets, because you estimate when the border open, they will have a good news for the Malaysia's markets, so it goes up. After that, you're going to sell a higher point so that you can post the positions to earn. Okay, but after that, the downtrends comes when, like these downtrends comes when during the budgets of the Malaysians comes up. Okay, when you estimate that the budgets of Malaysians comes up and you know that the expenses going to higher, and even you know that maybe implement some of the taxations which will cause the markets to goes down or get down. So usually, if you didn't have the opportunity or even you didn't have the choice to short the market, what you're going to do is you have to quit the market and wait until the markets to having a next scenes or even the next insight of goes up. You only can enter the markets when you find the opportunity. So during this downtrend of the time, if you didn't have the chances or even didn't have the options to short the market, you just can wait and you just can quit from markets. So if using futures contract actually allow you to short the markets, you can sell in advance if you think the market will goes down. And here is the another or even like the extra opportunities that provide for all of the traders or investor, which we mentioned is as the buy direction of trading. Okay, when the market goes down, you also can sell the market in advance. After that, you can close the positions, buybacks in lower points so that you can earn from this downtrend. Okay, so this is another advantages for trading futures contract because futures contract are allowed to short. So another one is the futures contract is actually low transaction cost, okay, compared to stock markets. Because you all know that stocks is actually involving the brokerage fee, clearing fee, and stamping fee. Sometimes it will even go for percentage, which you invest more, then the charges will go higher. But for futures contract, we actually fix at one rate accordingly, okay, to each of futures contract. Which means you trade one contract, then we have a fixed amount or the fixed costs for one contract, and then you trade another contract, then you will just add up per contract that you're trading. So the transaction cost for futures are actually lower compared to stocks. And okay, another part I'm going to share with you all is about the market analysis. Okay, so market analysis that using for trader or even investor are actually two types. First type is technical analysis, as you all maybe before. What is technical analysis? Technical analysis is actually identify trading opportunity by analyzing a statistical trend gathers from trading activities. So technical analysis sometimes even like there are people using it because they believe that sometimes the trend of the markets is goes historically. They are having the same trend and then same patterns. That's why they come with some of the example of the indicator graph patterns. And also another is quite easy one is for the support and resistance, okay, which you can gather the information from the graph for technical analysis use. And then the second type of market analysis about the fundamental analysis, which is actually evaluating the intrinsic value of an asset, and it will analyze the factors that could influence the price in the futures. Okay, for example, maybe for trading futures, the fundamental analysis involving some things is including the weather, government policy, economic outlook, pandemic sector analysis. We are going to share your for the fundamental analysis more at upcoming sections. Okay, so first here is the technical analysis that have been said. There's just some examples for here. You see this line is for the support and resistance. Okay, and then here you could see the curve. It's actually we call it as EMA, which is the exponential moving average. Okay, there are actually three lines in this graph. If you look at more details, there are actually three lines which involving in this graph is EMA 20, EMA 50, EMA 125. Okay, then the downside here is the RSI, which is the relative strength indexes. Okay, is used to determines whether the market is oversell or oversold or overbought. Okay, which the indexes and also the reading for the RSI. Okay, this is technical analysis. Then the fundamental analysis that I'm going to share, I'm going to separate it into two parts. The first part is the FKLI. Okay. Fundamental analysis involving or affecting the FKLI. The first one is about the interest rate. Okay. Interest rate, for example, for the BNN, Bank of Malaysia, means for the overnight of the policy rates. Okay, as you understand the interest rate, when the interest rate is higher, then the cost for business to loan or even like run the business become higher. So this will become or even like bring not a good news for the FKLI markets. The second one is the government policies. Okay, for example, like the budgets that have been bring out when the budget's having taxations, lump sum, the taxations goes higher, then we will bring the impacts to the markets. This is one of the fundamental analysis that's very related with the government policies. Also, there were some things good when the companies come with some of the promotions and then some of the tax exemptions, which will attract foreign investments. Okay, so the government policy is very important, or even is key factors that involving or even like affecting the FKI. The third one is the political issues. Okay, stabilities of the political conditions is also affecting the FKI because it's involving the confidence from the foreign markets or even the foreign investment, whether they are having confidence enough to invest in your country when the politics is not stable. They are going out from markets, which will bring an impact to FKI. So this is also one of the factors that are quite important when looking through the fundamental analysis for FKI. Fourth one is the global economic overviews. And they are come with the COVID-19, right? Everybody knows they have a big impacts to all over the country. So it will also brings the impacts to FKI. And they're also including like the good news when the COVID-19 to get better, then all the borders become open. So the activities, economic activities back to trend or even back to normals. So this will become one of the advantages or even the good news to makes the FKLIs go higher. So this is also one of the factors that you need to consider when you're looking for the FKI. The FCPO parts, I've shared three factors that you need to caution of if you are looking for the fundamental analysis. The first one is for the weather. Okay, so the weathers including for the La Nina and El Nino, and then some of the natural disaster including like floods. This is very important, which because they are affecting the plantations. Okay, maybe some of you all didn't understand what is La Nina and El Nino. Okay, actually El Nino and La Nina, they are actually the intermittent climate phenomena that originates in the equatorial of Pacific Oceans, which means they are actually affecting of the changing climate. Okay, which will affecting the plantations where their productions is, especially for FCPO, this kind of the plantations or even the agriculture's products. So the weathers are affecting very significant to this FCPO. Okay, so you need to caution about the weather. Then the second part is the festival seasons. Okay, when every time it's come with any of the big festival, including like the Chinese New Year, Diwali, Hari Raya, there's some of the biggest big countries, especially like Chinese New Year for China, Diwali for India, they're actually having a higher demand for crude palm oil, which is for the edible oil, because they are going to have use more in their festival. They're going to expand it or even use it in a fast pace. So they will increase more demands for FCPO, which cause the price goes higher. Okay, the festival season is the points that you need to caution of. And the third part is the competitions between the edible oil. Because for crude palm oil, as I said before, is edible oil, but it's actually having other substitutes oil also in the markets. There, for example, is the soybean oil and the RBD palm oilings. They also can make to use for other type of edible oil. So the price for these competitions between the edible oils is also affecting for the crude palm oil. For example, when other oils goes down for the price, then we also sometimes affect for the price of FCPO. Okay, especially when the theory is come with when the buyer or even the user consumer can having the lower price of the soybean oil, so they are not going to buy for the crude palm oil. Then the crude palm oil price will eventually goes down to compete with others competitions oil. Okay, so this is also the third points that I'm going to share. And last part I'm going to share is the difference between stock and futures. So stock and futures, they are actually different. things, especially for dividends. Stock are entitled for dividends, but futures are no. And futures are actually allow you all to short selling, but for stock market, not allowed to short selling, or even like it's only selected stock are allowed to short selling. Okay. And for futures, they are having underlying assets. For stock, there are no initial margins involving in futures, whereas the parts, the leverage come on, but for the stock, there are no initial margins. And the stock having the ownerships, but for futures, you are not having the ownership. Okay? The commission parts that have been shared before, the futures commissions are actually lower than the stock markets. Okay, come to the summary that I explained with you all. What is the contracts? What is futures contract? Futures contract are actually a derivative financials contract that obligates parties to transactions at a predetermined futures date and price. And then I explained you all three players in futures market. After that, I've been learned with the three terminologies and also the advantages of futures that have been shared with you all. So how are you going to start trading if you are interested in futures? The first part, you need to know about your own risk appetites. You are a high risk taker or you are a low risk taker. After you identify these, you need to study the products before you enter the markets. It's very important. You are not advised to enter the market without understanding how the markets works and what is the fundamentals issue or factors that affecting it. And then you need to understand the fundamentals, technical analysis for the markets. After that, you just consider to open a trading account, and then you can start to create a journey after you get your account. But you are very important to remember, when you start to trade, you need to update with the market's news. Okay. So for the Q&A sections, I will pass to Shereen to bring out for the question.
Okay, so thank you for Mr. Lim Hong Sing presentations. Now we will move to before we move to our Q&A side. So I want to explain that no matter you are our client or not, we will offer one-to-one free coaching sessions, free seminar and webinars, and free account openings. So for the free one-to-one coaching sessions, the key topic that we are focusing are introductions to futures tradings, product knowledge, platform coaching, and our charting system. So next, we also conduct free webinars and webinars regularly, but since we do not organize seminars at the moment, so we will be focused to provide more live webinars with different topics for you guys to join. So next, this is our upcoming webinars, which is the trading opportunity for the crude palm oil. So if you guys have interested, you guys can scan the QR code for the registrations. Besides that, you guys also can follow our Facebook page for more upcoming events and seminars. Yeah, so I will leave it for a while, for 1 minute for you guys to scan if you guys are interested for these webinars. After this, we will proceed to the Q&A section. Okay. So now we will go to the Q&A sections. Okay, so let's see what is the Q&A sections. Okay, so there is one question from Mr. E. He's asked that what is the difference for open contract vs the volume? So for this part, I will do some simple explanations. So actually for the volume, like actually it's the number of trading that completed by every day, and it's a very important things for you guys to measure the strength of the contracts. Well, for the open contract, actually we call it as an open interest. So actually the open interest is for you guys to reflect the number of contracts that held by the traders and the investor in every active positions, which is the active contract for you guys are ready to be traded. So this is the difference between the open contract and the volume. Okay, so next, there is questions. So they ask that for the top 30 company KLCI, is it fixed or it will change it from time to time? So if yes, how often the top 30 company they will be revised? So for this question, actually the KLCI index, right, will be reviewed by semi-annually, which is 6 months twice. So actually the KLCI top 30 company, right, has not been fixed. Okay. Okay, so next is on the example part. So this wanted to ask that the 10 points times 25 ringgit or the 10 points are times 50 ringgit. Okay, so let me make a simple explanation on this. Actually, 1 point of KLCI is 50 ringgit, but KLCI movement is moved by 0.5. So 0.5 are equals to 25 ringgit. So which means 1 point is equals to 50 ringgit. So when end of the day, you are earning 10 points. So actually you just need to times 50 ringgit. So 500 ringgit will be your profit side or your losses part. Okay. Next, another question is from, okay. So how much is the initial capital for you guys to start up this futures market? So Mr. Lim Hong Sing, maybe you can try to answer on these questions.
Um, yeah. For the initial capital to start up, and actually, if you are wish to open account with us, the initial capitals for you, if you are interested to trade for these local products, which is, for example, the FCPO, FKLI, you just need to deposit for 1,000 to open account. But if you want to start to trade for the FKLI or the FCPO, yeah, need to pay out for the different amount of the initial margin, which I've shared just now. For FCPO, the initial margin required is 7,000, and then for FKLI, the initial margin is 4,200. Okay. So in short, if you wish to open account, it's only need 1,000 for foreign for locals, and for start trade, yeah, you need to depends on which contract that you are interested to trade on.
Okay, thank you for your answer, Mr. Lim. So there's another question that I want to ask. How do Phillip Futures able to support all the investor if the investor are invest through Phillip Futures?
Okay, for this question, right, actually, as free futures, we're actually providing difference or even have many of the free webinars, especially to our clients, and also we have groups to share all those of the news that's from the markets and to make sure all of our clients is updated with the markets. And for the supports, especially if you're having the any of the requirements, you can actually ask from the broker, and as a broker, ask for your dealer, and our dealer will help you as soon as what we can do, especially when you need having of the requirement to understand more about like private coaching, and then what is the news that you wish to receive more news from.
All right. So thank you for your answer, Mr. Lim Hong Sing. Okay, so that's all for the Q&A sections. So now we will move to our system. Okay, so we have successfully launched the first futures trading online account opening in Malaysia. So if you guys got interested, you guys can open futures trading account online with no hassle. If you wish to open futures trading account by online, so feel free to visit our website, or you can scan the QR code and it will directly link you to the online account opening form. If you need guidance on the online account opening, please do not hesitate to contact us. So for free account opening, you will receive complementary mobile and desktop platform at no cost and access to a wide variety of products, including global futures commodities, interest rate, indexes, and metals. So the trading platform for futures trading is using Phillip Nova, which is commonly used by our client to access the global products. So for the desktop versions, it's used by web-based platform, but for mobile versions, you can trade using Phillip Nova applications, which allow you to trade anywhere at any times. Next will be our ongoing promotions. First is the Phillip Star Trader. So you can start accumulating your points, which is by today, and get reward with the exclusive prize worth at a total of 50,000 and a cash reward up to 4,000 by trading futures and CFD share from 1st of July until end of December. Second is the promotions, which is to the moon with the micro e-mini contracts, which trade a minimum of 10 lots of micro contract products from 1st of November until end of this November. Then you will be entitled to enjoy a commission of USD 2 ringgit. So if you guys have interested, you guys can scan the QR code to learn more. Next, so you guys can contact with us now on Facebook, LinkedIn, or YouTube by searching Phillip Futures Sendirian Berhad, and Telegram by searching Phillip Futures. So do like and subscribe our page if you haven't. We will consistently update our event, promotions, announcements, and market news. Our recorded video will be uploaded on our YouTube channel too. So if you guys have any inquiries, please do not hesitate to contact us, even through call, emails, websites, live chat on Facebook Messenger. Our representative will contact you as soon as possible. So if you have any questions, feel free to contact us and we are happy to assist you. Last but not least, you guys can check out on our latest promotions and grab the opportunity to go and join it. So with that, I will end the sections for today. So thank you for everyone for joining our webinar today. And also thank you so much to Mr. Lim Hong Sing for his insightful sharings. So good night everyone and stay safe. Bye bye.